Hi, my name is Nolan Baker here at America's Retirement Headquarters. Thank you so much for tuning in today to learn about our strategy that we're talking about called asset-based long-term care. So with asset-based long-term care, one of the goals that we have is to help you achieve more. And specifically what we want to do is we want to help you avoid the risk of loss, we want to maintain liquidity, and we want to be able to show you some ideas that if you or a loved one has some form of long-term medical care or healthcare crisis, is there a way to leverage your current dollars to get more bang for your buck? And that's one of the potential solutions that we have in today's presentation on asset-based long-term care. Where there are some opportunities and where this might apply to your situation is, number one, if you have what I would call lazy assets. So sometimes I refer to them as an emergency account. You know, life's going to throw you a what if. You just don't know when that's going to happen. It's always a good idea to have a bucket of money that's designed for those what ifs. But, you know, with low fixed rates, you know, that can be kind of a lazy asset right now. That could be a strategy that we could talk to you about to help you achieve more. If you feel that your family's tax rates during your lifetime at some point in the future could be higher, and while the tax rates still are historically low, if you want to take some steps to begin to detaxify your retirement accounts and systematically shift and move money over from the tax deferred to the tax-free category, this can be a strategy for you to consider as well. The third is increased yield. So if there's a way to increase the amount of predictable income, commonly what I refer to as found money inside of your portfolio, and if you didn't necessarily need that money on a monthly basis, we could reposition that money into the asset-based long-term care solution. And fourth is just an increased opportunity with some of the other fixed income investments that are out there. This could be your bonds or bond funds or low interest fixed investments. You know, in a rising interest rate environment, historically speaking, some of the fixed income investments have had some real challenges, if not lackluster performance during rising interest rates. So I'm not sure what your opinion is of rising interest rates, but if you're worried a little bit about how that could negatively impact some of the returns on a portion of your fixed accounts, I'd love to have a conversation with you about this asset-based long-term care solution, which is another way that could help you achieve a little bit more. So let's walk through and let's look at an example of how this might apply. What I would also tell you is that if you'd like to have a conversation about your individual situation, all you need to do is give us a call at the office at 419-842-0550, and we can tell you in your particular situation some of the ways that this might apply and how we could help you get an illustration and show you how these numbers will work in your own family situation. But since we're limited on time and I wanted to give you an example of how this works, we will take a female aged 60, and let's just say she is in standard health. So, you know, just an average everyday American. In this case, let's call her Mary. So maybe Mary has identified that she has $100,000 of what we could call lazy assets. So you might also have some lazy assets as well. Those could be assets in most traditional fixed savings investment accounts, fixed income type of investment vehicles. There's a lot of different ones that maybe you could identify even in your own financial situation that you would call lazy assets. And with interest rates at historical lows, you know, those are safe, but the opportunity is really not there as well. In Mary's situation, if she repositioned $100,000 of those lazy assets, the first thing that she does is she has 100% liquidity. So if for some reason Mary ever needs that money back, Mary has some type of an emergency, or for whatever reason she decides that she would like to close this account, Mary can cash in this account without any fees, expenses, and penalties. Mary also has the opportunity on a yearly basis that she could participate in gains based upon the underlying index that she chooses as up to roughly 10%. So we could have gains of 10% per year based upon how an underlying index does. And she could also have 100% safety of her principal. So in this case, she is not taking risk to her principal declining if and when the index goes down. So here Mary has liquidity and has much more of an opportunity. Now, if Mary never needs this money or Mary simply passes away, the second thing it's going to do is it's going to give another benefit. So in this case, Mary is also going to get this second bucket. In fact, Mary's probably not going to get it because this particular bucket is a bucket that's paid out in the form of life insurance. Using Mary's example, her $100,000, upon having this put in force, is immediately worth $200,000 in her example. Now, because of the fact that it's life insurance, if she properly names her beneficiary, one is it avoids probate. And the second thing, because of the fact of it being life insurance, those assets can be passed on 100% income tax free to who she names as her beneficiary. So if you would want to try to achieve more and pass more on, either to protect your surviving spouse in the event of a loss of an income, if you want to achieve more and help maybe your children get a better jump start in life and maybe give less in the form of taxes by creating some tax-free dollars, or if there's a charity or an organization that's important to you as well, this can be another strategy in the second bucket of money. The third bucket of money that Mary gets is Mary also gets a bucket of money that could be used in the issue of some form of healthcare crisis. So that $200,000 is also available for Mary in the event that she has some form of critical, chronic, or terminal illness. So critical are normally defined as one-time type of an occurrence. Chronic is defined as things that you cannot perform your activities of daily living. And a terminal illness is defined by your family doctor as your prognosis is you're not likely to live past 2 years. In all of those situations, she has the ability where she could get to some of this money to use it to be able to help her maintain control and independence. So she's taken her $100,000 and she's leveraged it into $200,000 of additional benefits without buying long-term medical care for this healthcare bucket number 3. This is a great example of an asset-based long-term care solution that allows you to potentially achieve more than what you could potentially get in some other traditional fixed income accounts with today's low rates, as well as the risk in rising interest rates with some investments like bonds or bond funds. This can be a way to help you achieve more with protecting your spouse from a loss of income due to a premature death, or helping you achieve more for your loved ones being your family or a charity. Or it's a way to help you get some protection over and above your assets without buying traditional long-term care. I'd love to have a conversation with you and connect you with one of the financial professionals here at America's Retirement Headquarters and show you a specific strategy on how this could apply to your situation. If you'd like to learn more or have a conversation, all you need to do is just give me a call. You can call the office at 419-842-0550. Again, I'm Nolan Baker here at America's Retirement Headquarters, and I just had an opportunity to talk to you about a unique approach that might apply to your situation called asset-based long-term care. So again, to learn more, just give me a call at 419-842-0550.